Welcome to this explainer. Today, we're diving into Matthew B. Jameson's incredible masterclass on the history and the digital future of finance, ETFs Unveiled.
Exchange-traded funds, or ETFs, they've literally completely transformed from this kind of obscure, niche financial concept into a multi-trillion-dollar force. They completely democratized global finance. They tore down those massive walls that used to keep everyday retail investors, like us, out of the most lucrative and complex markets. So, over the next few minutes, we're going to trace this incredible revolution together. We'll unpack exactly how it all started. Look at the massive hurdles early pioneers had to overcome, the crazy structural stress tests these funds survived during historic market crashes, and ultimately, where the digital frontier is taking us next.
Okay, let's dive into this. Here is our roadmap for today's journey. 1. The birth of ETFs. 2. Pioneers and early challenges. 3. Expanding the ETF universe. 4. Navigating modern market storms. And 5. The future of investing.
Section 1. The birth of ETFs, bridging the gap.
Now, to truly appreciate this whole financial revolution, we really have to look back at the original problem investors faced before ETFs were even a thing. There was this massive gap in the market that desperately needed filling, and this comparison brilliantly illustrates that core dilemma. On one side, you had traditional mutual funds. For decades, they were the absolute gold standard because they gave you great diversification. But here's the catch. They were severely limited by end-of-day pricing constraints. So if the market's crashing at 10 a.m., well, you couldn't get out. You were literally trapped until the market closed and the final net asset value was calculated. Now, on the other side, you had individual stocks. These gave you real-time intraday tradability, meaning you could react to news instantly. But you severely lacked instant diversification, unless, of course, you had massive amounts of capital to buy hundreds of different companies. So innovators realized they needed a hybrid. They needed a highly efficient vehicle that combined the second-by-second tradability of a single stock with the broad, protective exposure of a mutual fund.
Section 2. Pioneers and early challenges, the road to SPDRs. Building that perfect hybrid solution? Yeah, that definitely didn't happen overnight. It was the result of decades of trial, error, and just relentless innovation. Actually, the chronological march toward the ETF started way back in the late 19th century with closed-end funds. Now, those proved that a tradable fund structure was mechanically possible, even if they frustratingly traded at premiums or discounts. Fast forward a bit to the 1970s, and the American Stock Exchange introduced index participation shares, trying to map a portfolio directly to an index. Then, in 1990, the Canadian market really pushed the envelope with the Toronto Index Participation Fund. But the real, absolute world-changing breakthrough, that hit in 1993 with the launch of Standard & Poor's Depository Receipts, better known as SPDRs. This monumental launch was spearheaded by pioneers like Reginald M. Brown and the team at State Street Global Advisors. And honestly, that moment effectively gave birth to the modern ETF industry.
Now, what's really interesting about this slide is the ingenious mechanism that actually made SPDRs work. It's called the in-kind creation and redemption process. This is the secret sauce. Step 1. Authorize participants. So these are usually huge institutional investors or market makers, exchange a specific basket of underlying securities. Step 2. The ETF issuer takes that basket and creates or redeems ETF shares in kind. And finally, Step 3. Those newly minted shares are traded by everyday investors intraday on the stock exchange. Now, here is the genius part. If the ETF's price ever strays from the actual value of its underlying assets, these authorized participants step in to arbitrage the difference, essentially buying or selling the underlying basket. This exact mechanism is what keeps the ETF's price beautifully aligned with its actual net asset value minute by minute, without completely disrupting the broader market or triggering massive capital gains taxes.
But of course, a truly revolutionary idea almost always faces intense resistance at first, right? As the author notes, the concept of an investment vehicle that combined the benefits of stocks and mutual funds was unfamiliar to many investors. Pioneers like Reggie Brown had to launch these massive nationwide educational initiatives. They weren't just selling a new fund, they were literally retraining the entire market on how to invest. And on top of that, they faced incredibly steep regulatory hurdles. They had to work extensively with the SEC to prove, beyond a shadow of a doubt, that intraday trading of a massive fund would actually protect retail investors, maintain deep liquidity, and honestly, just uphold overall market integrity.
Section 3. Expanding the ETF universe beyond the S&P 500.
Let's move to the next phase and see how this builds, because once the SPDR proved the concept worked, man, the floodgates just opened.
In 1999, right in the absolute heat of the dot-com boom, NASDAQ launched the QQQ to target tech-heavy indices. This gave investors totally unprecedented access to the technology sector under a single ticker. Just a year later, Barclays Global Investors launched iShares, driving massive international expansion and basically allowing anyone to buy into global markets. From there, we saw the rapid development of sector and style ETFs that allowed investors to target very specific industries, think healthcare, energy, or financials, with laser precision. And eventually, we even saw the rise of actively managed and smart beta ETFs, which really blurred the lines between passive indexing and active stock picking. All of this just proved the incredible, almost limitless adaptability of the ETF structure to meet literally any investor's needs.
If you find this analysis valuable, please like and subscribe to Knowledge Lighthouse to help us bring more truths to light.
Section 4. Navigating Modern Market Storms, Tests of Resilience.
Okay, getting back to our timeline, it definitely wasn't all smooth sailing. As ETFs grew in popularity, their structure got severely tested by some major market crises and periods of just extreme, unprecedented volatility. So let's look at how the ETF structure actually held up under pressure. During the 2008 financial crisis, those turbulent times rigorously tested ETF liquidity. While the underlying bond markets essentially froze up entirely, ETFs actually continued to trade, providing some much-needed price discovery. Ultimately, the structure proved highly resilient, acting like a critical pressure valve for the broader market. But then came the 2010 flash crash. That caused extreme, honestly terrifying intraday price dislocations for some ETFs, with prices plummeting to pennies in mere seconds. This forced a massive, immediate regulatory response, leading to a critical reassessment of circuit breakers and trading halts, like the limit up/limit down rules, just to better protect investors from these kinds of technological market glitches.
Now, beyond broad market crashes, we also see that different asset classes carry very distinct structural risks that we, as investors, really need to understand. Take the United States Oil Fund, or USO, for example. It faced massive challenges managing contango, which, if you're unfamiliar, is the costly friction of continuously rolling futures contracts forward when future prices are higher than spot prices. This was incredibly tough during extreme oil market volatility. Or consider the ProShares SVXY. That fund had to navigate the highly complex and inherently dangerous dynamics of inverse volatility-linked products, which can suffer catastrophic losses during sudden VIX spikes. And more recently, look at the ARK Innovation ETF, ARKK. That really showcased the unique liquidity pressures of handling rapid, massive capital shifts in highly concentrated, disruptive tech themes during a broader market drawdown.
So the crucial point here is that despite these historic foundational storms, the ETF market didn't just survive, it absolutely exploded. Welcome to the $1 trillion club. I mean, that is enough zeros to make your head spin. This staggering scale, well over $1 trillion in assets under management for just the top individual funds alone, reflects an immense, undeniable shift in global investor trust. It literally represents one of the greatest migrations of capital in human history, with money moving straight out of high-fee mutual funds and directly into highly efficient ETFs.
Section 5. The Future of Investing, the Digital Frontier.
Now that ETFs absolutely dominate traditional finance, what does the leading edge of this universe look like today, and where exactly is it heading tomorrow? Well, we are seeing a massive explosion of thematic funds and deep technological advancements. There's the rapid rise of ESG integration, which weaves environmental, social, and governance factors directly into index construction. We're seeing algorithmic and high-frequency trading completely reshape market liquidity, making spreads tighter than they've ever been. And fund operations? They are increasingly integrating blockchain and AI to streamline complex portfolio management. But perhaps the most talked about paradigm-shifting frontier right now? Cryptocurrency ETFs. These are finally bridging that long-standing gap between deeply regulated traditional finance and the Wild West of digital assets.
When we look at this new crypto frontier, there are really two primary structural approaches trying to tame it. On one side, you have index-based crypto ETFs. These passively track a predefined index of digital assets, giving you broad, straightforward exposure to the largest coins. Super simple, right? On the other side, though, you have actively managed crypto ETFs. Now, because crypto operates 24/7 and is notoriously volatile, these funds rely on seasoned managers making discretionary decisions. They're trying to generate alpha, essentially outperforming the market by expertly navigating this highly complex and rapidly evolving digital ecosystem.
But here's the thing. To bring trillions of dollars of institutional trust to digital assets, specialized security is absolutely mandatory. And that brings us to custody solutions. You see, unlike traditional stocks, if a digital asset is stolen, there's no takebacks. The transaction is irreversible. So these highly secure storage mechanisms, things like offline cold storage and multi-signature protocols, are completely essential. ETF issuers have to rely on these sophisticated military-grade safeguards to protect massive digital asset holdings from the unique hacking, theft, and operational risks that are so uniquely present in the crypto space.
Which leaves us with a totally fascinating operational question. As global passporting initiatives expand, how will regulatory harmonization shape the cross-border future of ETF investing? I mean, right now, different countries treat crypto and complex ETFs completely differently, and that creates massive friction. Achieving true global regulation is still an ongoing challenge, but it is one that will absolutely dictate the continuing evolution of global finance.
While we've spent this explainer looking at the crazy digital revolution of finance, high-frequency trading, and the cutting edge of digital assets, there is still something incredibly valuable and grounding about tangible, lasting knowledge that you can hold right in your hands. For the complete deep dive, own the paperback. Get your high-quality paperback edition on Amazon via the link in the description. Add it to your collection today. Please share this explainer and check the description for more. As these markets evolve, the question is, are you ready for the digital frontier?